So we've got a few questions from you guys, very important questions about the trigger point, how the levels are showing on the chart, how they are generated, and how to use the accelerometer, how to trade news, and a good method to trade prop firm, how to use the trigger points with the ICT zones and divergence, and several questions we've got from you guys about the automatic strategies and how to take advantage of them. So thanks again for the questions. A brief overview for the new audiences who have yet to know us. We are a team of researchers, day traders, and AI experts providing tools for day traders, stocks, and futures. And we are here, guys, to take the guesswork out of your trades and to simplify a little the trading for you based on our experience and knowledge in trading and computer science. And I invite you all to subscribe to our YouTube channel and learn more about how we view the market. We also offer free services like live trading room and indicators you can take advantage of. You can download them from our Discord server anytime. So we got many questions from you guys, important questions, and the way I'm going to address them is by going through this agenda. Let present a brief overview of our trigger point, which is our most popular product. It provides you with key levels daily, and I'll show you how you guys can take advantage of them. More specifically, I'll talk about the current day's trigger points and the previous day's trigger points, the golden levels, how many days to load, how to take advantage of them, and how to increase your confidence in trading. I'll speak about the accelerometer, how to use it, and basically what it aims for. Then I'll speak about high probability setups, what I call confluence trading, and I'll speak about our automatic strategies. I'll share with you how I use them, how I take advantage of them. And I'm talking about the trigger bot, price action bot, divergence, and fair value gap bot. In addition, you guys asked for ideas or tips on how to trade prop firms and how to trade news, and I'll share with you the way I do it. So this is the agenda, and the session will be divided into several parts. Today is the first part. So I speak about a trading arsenal consisting of three types of things or families. The first is high probability entries, position entries, entry confirmations, confluence, and position management. And the relevant indicators for each family are the trigger point for entries, price action, confluence, divergence, and fair value gap zones can confirm the entries. So these are confirmation tools. And the third family, which is the position management, includes the dynamic Fibonacci and the trailing stop. And now, to answer your questions, let's start with the first one, our trigger point, which is the most popular product of EG indicators. And I personally very proud of it. So this is a trigger point. This is how the levels are showing on your chart. So the first question was, do the trigger point levels repaint or are they fixed once plotted for the day? And this is a very important question, guys, because when I looked for support and resistance solutions services, I only found either repainting levels or indicators that require fine-tuning. So this is a very important question, and I'll answer it in a minute, because this is what differentiates us from others. So our trigger points are key levels provided to you daily, 10 hours before the market opens. And here is an example. Each trading day has a unique set of trigger points, red for resistance and green for support. When the levels are delivered to you guys, the market is located in the middle, between res zero and sub-zero. So this is the delivery time. This means the market in this example was here, and our algorithm which runs on our cloud server, consumes at least 10 years of historical data to understand behavioral patterns and to deliver the trigger points for you for the current trading day. And when this happens, the market moves between the first resistance and the first support, res 0 and sub 0. So these levels, guys, are showing on your chart red levels above the market and green levels below the market. And then if you follow the market, just like this is the first touch. And we spoke about the first touch rule several times, and today I will explain it more deeply. So this is the first touch of our support level. So sub 0 and res 0 are basically the first lines the price can reach to. In this example, the market creates a double bottom under our trigger point support level, which is expected. And today, guys, you are going to hear this word a few times, many times. Do you know why? Basically, why double bottom are created in many cases of significant price levels? Why? Okay, let's explain that, because this is going to be very, very important for you to understand the price action when it comes to significant price levels like ours. So when you place a pending order, guys, there should be a seller on the other side for your order to get filled. So a seller is coming, your order is getting filled. His order is a market order. There's a seller who pushes the sell market button, and your buy order is getting filled. And the position is active. Now, what do you want the market to do? To go to the upside, of course. Then you're in profit, and if it goes more, your profit increases. Again, before and after. The market is reaching a level in this example. You place a buy pending order on the first touch, a seller is coming, pressing the sell market button, and your order gets filled. Now, let's take a look at what happens before in the left side here, because it's very important to understand. So you're placing a pending order, and let's say another one is placing a pending order, and another one, and another one, and there are many buy orders resting here below the support or at the support until there are stacked buy orders here. Let's say thousands of buy orders. However, just a few sellers. So this seller takes this order, position is active, and this seller takes this order and another position opens, and this seller takes this order and another position is active. But still, there are many unfilled buy orders left below the support. Many orders remain unfilled. Let's say thousands. Therefore, in this case, the market reverses because it must go somewhere. And the filled orders here are lucky because they're in green, they're in profit. Remember, guys, when there are stacked buy orders, the market must reverse, go to the upside, since there are not enough sellers to push the market to the downside. And that's the result. So again, usually, because there are many orders unfilled, buy orders here, the market goes to the upside. Now, guys, I have a question for you. Who can place so many orders and influence the market like this? Because you all agree with me, stacked buy orders do not influence the market. It only market orders move the market. But because there are many stacked orders and the market must go somewhere, it reverses. So who can place so many orders and influence indirectly indirectly influence the market like this. And what will probably happen if the orders are all filled because there are enough buyers or canceled? And the sellers push lower and lower and lower. Many sellers, they are pushing the market lower. They will have enough room to move the market to the downside. And then, guys, a huge break is observed. So again, stacked orders are filled or canceled. Let's say they are immediately filled or immediately canceled because there's a pressure of sellers, leading to a huge break, a sudden break. So considering this case, first touch didn't work in this case. You agree with me. We expected the market to bounce back off support, but it didn't happen. This support level didn't hold. I mean, it held a little, but then it broke. So first touch didn't work. So in the first case, the left case here, the first touch rule didn't work. In the second case, first touch worked out nicely. In the first case, the market behaved unexpectedly, and in the second case, the market behaved expectedly. In the first case, the buy orders were filled or cancelled, leading to a sudden move to the upside. And in the second case, the market bounced off support, as we expect, because it's a support level. Okay, so in this case, the market reversed, bounced off support 0. Guys, in real life, orders are getting in and out. The market is very dynamic. However, on a significant price level, there will always be orders getting in or sitting there, unfilled orders, leading to a reversal. You can think of it like those orders prevent the market from going to the downside. Although there might be sellers coming here and there, but the buyers are in control, meaning in many cases, the buy orders cannot be filled because there are too many buyers. Remember, buyers are in control, too many buyers. Buy orders cannot get filled. Buyers are in control. Buy orders cannot get filled. Too many buyers. These are all equivalent. Then what happens? The market reverses. Too many buy orders, too many buyers, the market goes to the upside. So again, you can think of it like these orders prevent the market from going to the downside. So this is why basically a double bottom is created, and of course it depends on the time frame you're looking at, because the market tries to break, then bounce back, tries to break, then bounce back, and double or even triple bottom is created below the support level. And again, because of so many stacked buy orders resting below this support level.